Hello students, this is a discussion on the economics optional paper of the year 2024. So as you know, there are two papers in all optional. First we'll be going through the paper 1 in this particular case, and later on the other paper. So let me introduce myself first of all. I am Shyam Sundar. I teach economics optional at Vajiram Ravi, and I have reasonably long experience in terms of teaching economics at various colleges in Delhi University. And the good thing was that many of the aspects which came in exam this year were also largely from the notes or the test series, etc., which I'm not going to explain again and again. The main purpose of this discussion is that since a number of students were demanding that some questions in paper 1 particularly they were facing problem with, and there was no ready explanation of that on the internet in the thoughtful manner, therefore I decided to talk about it. So let's move into the discussion without going into any other aspect. I'm not going into much of trend analysis, etc., although as we go on we'll do the trend analysis. The exact percentage of questions coming from micro, macro can keep on changing year on year, on which you don't have much control over. You have to take more or less all of them in equal way and focus more on the nature of questions which are coming on the different topics and prepare better on that. So let's begin. The first question was, this is paper 1, question number 1. As you know that there are 5 compulsory questions within the first question. It was differentiate between perceived demand curve and proportional demand curve in a monopolistic competitive market. The first part, explain why the proportional demand curve is steeper than the perceived demand curve. Okay, so as a 10 marks question, you have to be very to the point in this particular case. In monopolistic competition, we often talk of two types, perceived or planned demand curve. You can also call it the other way, and proportional or market share demand curve. Okay, it denotes the market share of a particular company. So in monopolistic competition, what happens is that whenever a firm is thinking that it will reduce price and it will be selling certain amount of good, it may not always come true, and that is the main reason why they are different. Actually, in the discussion here, we won't be able to write down each and everything in terms of the details, but I'll be focusing more on the graphical interpretation. So when we talk about the two types of demand curves, let's say here we have quantity, here we have price. Then one demand curve is the proportional, the other demand curve is the perceived. So in this case, let's say capital D, D dash is the proportional demand curve, and let's say small d, D dash is the perceived demand curve or planned demand curve. So the basic thing to understand is that suppose we begin with a price level, say P1, and the firm reduces the price to a level P2. The firm will be thinking or expecting that it will be able to sell a significant number of units extra. Like earlier, if it was selling Q1, now it will be able to sell Q2. But what it is forgetting is there are other competitors also. In monopolistic competition, there are other competitors as well. And the other competitors may also follow the firm in this price reduction, okay, in order to maximize their profit. So what will be the actual increase in quantity demanded will be given by the proportional demand curve. In this example, you can call it, let's say, Q3. Actually, the firm will be able to sell only, increase the sale only from Q1 to Q3, even if it thought it will be doing from Q1 to Q2. Obviously, apart from graph, you'll have to write the definition, etc. Like perceived demand curve is that demand curve under which a monopolistic competitive firm expects that how much extra can it be selling whenever there is a fall in price, and the proportional demand curve is the actual increase, or the actual increase is denoting the market share because other firms are also following in that way. The second part was why the proportional demand curve is steeper than the perceived demand curve. Very easy. In the graph also it is clearly steeper. Steeper in the sense, for any fall in price, if other firms are also following the same way, obviously the firm will be ending up selling lesser amount than what it thought. So for any lower price P2, if the firm is actually selling lesser amount than what it thought, then the proportional demand curve has to be steeper in that case. But a small word of caution, this logic will be mainly applicable when the prices are being reduced. Okay, when the prices are being increased, this kind of an argument will have to be thought again. In fact, although not asked in this exam, when we talk about another oligopolistic theory, not monopolistic competition, the kinged demand curve, there was no question on that. That is also influenced by this kind of a concept where it says that whenever there is a fall in price, the relevant demand curve becomes the proportional one. Whenever there is a rise in price, the relevant demand curve becomes the perceived one. That is why a kink in the demand curve comes in, which you didn't have to write here. I was just trying to say that when you show this in this exam, you have to show it for a decrease in prices. Okay, let's go further. The second question was discuss critically the phenomenon of classical dichotomy. Okay, this is a question clearly on the classical theory of macroeconomics. Dichotomy here is referring to the phenomenon that the real variables in macroeconomics like output, employment, etc. are not influenced by the monetary variables or money variables. The classical economists were strictly following the segregation between the real and the monetary variables. Okay, in fact, the oldest classical economists, that since the time of Smith, etc., they didn't even give much importance to the monetary variables. Even within classicals, it was only later classicals, the classicals like Marshall, etc., who at least recognized that money is playing a role, but still they considered that they are separated. That is why the term dichotomy. However, the question is not just asking what is classical dichotomy, it is telling critically discussing about it. Since it's a 10 marks question, you have to be very brief again. You have to first explain what is classical dichotomy. Then you have to talk about why such a dichotomy can be regarded as an ideal feature of the classical model, and also criticize it. Okay, more importantly, you'll have to criticize, because that is what the Keynesian economics does. It said that this kind of a segregation is not very correct. However, it cannot be criticized only. For example, in order to handle this question, you can even bring in some of the lessons that you learned from the other schools of macroeconomics. For example, the new classicals, etc. New classicals who kind of represented the classicals of earlier with some change also strongly believed that the real and the monetary variables are separate. For example, they show the business cycles, etc., are mostly influenced by the real variables. So you can, in the favor of classical dichotomy, you can also bring in the arguments given by the new classicals, because after all they were trying to justify some of the conclusions of the classical theory. When you are criticizing, you can use the Keynesian theory. Like Keynes said that the real and nominal variables are interlinked. That is why in the criticism you can talk about the equilibrium being achieved through interaction between product markets or market and money market. That is most clearly given by the ISLM framework. Basically, the product market is given by the IS, money market by the LM. The moment, I'm sure all of you have done ISLM, those who are appearing for economics optional, you must have done IS and LM, and you see that in the Keynesian economics, it is ISLM interaction which is giving the equilibrium or determining the real variables also. So there is no dichotomy between them. I think even if you write it briefly, it's okay. Being the word limitation, you can't do a lot because you have to do three things here. One, explain what is classical dichotomy. Second, why it can be justified. Another thing that you can say that in longer run still it may be somewhat justified. Later on it was found that Keynesian theory was more applicable in short run and classical more in the longer run. That is another way you can also say that. But beyond that, it is also a kind of a different school of thinking that it is happening. And one of the things also which is responsible for that is the classicals always thought that wages or interest rates, etc., are fully flexible. Okay, there is no rigidity. And that is one of the reasons why they could have separated the real and the nominal variables. While in Keynesian theory, there is no such fundamental necessity that wages or prices or interest rates, etc., will be fully flexible. Although that was not being asked here, so try to keep it relatively brief. Okay. Coming to the third question among the compulsory one. Now, this I would say was the most unique question which was asked in this exam. Show that ad valorem tax is preferable to specific sales tax from a firm's point of view in generating the same amount of revenue. Okay, this is a question from public finance and a very unique one because normally we have seen questions where they ask that how the tax burden or incident changes with the nature of elasticity or with the nature of say specific sales tax or the ad valorem tax. Okay, what I'll tell you is a brief graphical way in which you can interpret. Now, I heard that some people are giving the argumentative explanation that the ad valorem tax is on the basis of value, so government always have enough flexibility, which is okay, justified, but that kind of an answer is expected from a GS student, not from an optional student. If you have no other argument, then you have to do that. Being an optional student, you have to use graphs wherever it is needed and show in a proper manner graphically, if it is possible, that why that is happening. So I'll be mainly focusing on the graph over here. So what you can do is that you can talk about a standard demand and supply curve. Okay, downward sloping demand, upward sloping supply curve, equilibrium, let's say given by E1, and then accordingly the quantity and price, let's say Q1, P1, and then there are two things here. One is the specific sales tax. Specific sales tax is typically on the quantity of the good. Okay, you can also call it a per unit tax, by the way. That is on the quantity of the good that is can be there. For example, on certain units of a product or certain other quantities, liters of some fuel and so on. So here we can talk about per unit. To keep it simpler, why go into much detail? Suppose the specific sales tax is T rupees per unit. T rupees per unit means that for each unit of Q, there is a T per unit of the specific sales tax. How can we show that in graph? Actually, there are two ways of showing the impact of a per unit or sales tax, either through a leftward shift in supply curve or in the demand. Supply curve is more appropriate because it shows that how the producer is charging the prices from the consumer. So suppose that we do the same way. Let's take that supply curve to the left side. Let's give them name S1 and S2, and this vertical distance is your T. This is how we in general talk about the impact of the tax, and therefore the equilibrium will be now shifting to E2. At this level, lesser amount Q2 will be sold at a higher price P2. Okay, but the question is not just asking, it is asking that show that ad valorem tax is preferable to such a tax in generating the same level of tax revenue. Generating same level of tax revenue from the firm's point of view, meaning thereby the firm is collecting this tax revenue and giving it to the government. So in this case, what is the tax revenue that firm will collect in case of the specific sales tax? It is selling Q2 amount at a P2 price. Look at it, it is selling the Q2 amount at the P2 price. Earlier it was selling P1 at P1 price, the Q1 amount of quantity. So basically now the consumers are giving them a higher price, which is P2. So the difference in price is P2 minus P1, and how much of units are being sold? Q2. Let's call it O for origin. So OQ2, or this much, is being sold. Let's give this point a name again, call it F. So in this case, the tax revenue which has been generated is equal to the area of this quadrilateral, or you can just say rectangle. So in this case, T per unit of sales tax, you can say the tax revenue collected by the firm. The tax revenue collected by the firm will be equal to P1 F E2 P2. Okay, basically this area. You can shade it out if you wish, but I'm avoiding it so that it is not, it doesn't appear over complicated. The question, however, went further and said, show that for getting same revenue, ad valorem tax will be better. Now this is slightly tricky, but let me tell you one way to handle such a situation. How do we show ad valorem tax graphically? We show it through the demand curve swiveling leftward, not shifting but swiveling in an angular fashion. Why so? What is the logic behind that? You don't need to write these things because the question is already a little complicated. You have less time for that. I'm telling you just for the sake of clarity, because ad valorem tax is always on the value of output. By nature, ad valorem we mean as on the value of output, there is a percentage tax. For example, 10% tax on the value of output. Most of the taxes are actually ad valorem, say GST, etc. can be given as an example of the ad valorem tax. When it is as a percentage, you will see that for each quantity being sold at different prices, the rate of tax will remain same, but the demand will not be shifting downward in a perfect manner because it is on the value. Say P1 Q1, P2 Q2, etc. So you can show that as a swivel in the demand curve inside. Now we will swivel it in a special manner, in such a manner that the demand curve goes from the point which is F, something like this. Okay, it should be going through this point F. This is by construction. It's like we are telling, assume that there is X percentage of ad valorem tax such that demand curve shifts to, say, from D1 to D2, or swivels from D1 to D2 such that it passes through this. I'm sure many of you understood why did I do that, because I want same tax revenue. I want the same level of tax revenue over here. However, the matter is not yet closed. Let's do a few more things. If there is ad valorem tax, now forget about this supply for some time. If there is an ad valorem tax, the equilibrium will be here, E3, okay, where demand and supply is meeting after tax and the original supply curve. And in that case, the firm can sell Q3 amount of output at some price, call it P3. Okay, this is basically the argument. And what will be the tax amount? Tax rate, you can say. Tax rate will be this part. Let's give it a name also. Call this point as G. The tax rate will be GE3 upon E3 Q3. Okay, in this example, the ad valorem tax rate is GE3 upon E3 Q3. You can also say into 100 because we are giving it in percentage, but let's keep it away. That's not very important over here. Now, what is to be noticed here is that since this swivel is happening in a manner that the percentage tax rate should be same. Okay, whenever there is an ad valorem tax rate, the percentage is not changing. What does it mean? It means that you can take any point on this D1, okay, and draw a line vertically down. This distance between D1 and D2 upon the remaining will be the same rate. Like if you take a point here, just hypothetically, then this divided by this should be same as GE3 upon E3Q3. We are using this logic to come to our answer. By that logic, the ad valorem tax rate will be same even if we are at point F. So you can say equal to E2F, okay, divided by FQ2. We are talking about this divided by this entire part, the FQ2. Okay, and that will take you to the answer basically. What is the total tax revenue from this? The total tax revenue that can be generated from this will be the tax rate E2F upon FQ2 into the value of goods being sold at this point. What is the value of goods being sold? It will be the area of this big rectangle, which is OQ2FP1. Okay, the area of this bigger rectangle. What is the area of rectangle? The multiplication of the sides. So either you can say it will be OP1 into OQ2, but it is same as telling basically OP1 is same as your FQ2. Okay, why we are doing that? Because our FQ2 is here also. So either you can say OP1 into OQ2, or you can also write it as Q2F or FQ2, the same thing, into this part P1F, which is same as OQ2. So let's write it. I am not writing each and everything. A few things are left to your wisdom also here. So into FQ2 into P1F. Now this FQ2 will cancel out, and now look what is left, what we are left out with, E2F into P1F, which is nothing but the area of this rectangle. This was the same revenue that was generated in the T per unit. So this will be equal to the same thing, P1 F E2 P2. Basically the tax revenue has been collected as same with sales tax and the ad valorem tax. And now note one thing, this distance E2F is much lower than the distance T. Clearly this E2F is much less than T. E2F is this much only, T is the bigger one. Hence we can say that it is with a lower ad valorem tax, okay, that the firm can generate the same amount of revenue, and the specific sales tax needed for this will be higher. Okay, I am leaving the writing work to you, because if you get this, you get the main marks. The major argument has been taken up, and that is what I wanted to tell you. Okay, so that was a little tricky question, that I agree, and not a very expected one from here. Let's go further. Examine the role of treasury bills in controlling money supply. Although an easy question, again somewhat unexpected. Unexpected one because they have written exactly treasury bills only. Treasury bills are short-term government securities that I'm sure all of you know, even for your GS preparation you do these things. How does it impact money supply? And the word is examine. Examine is kind of telling that you can take both sides, as in you can even have a little critical view if you need to take up. Look, this is an easy answer. If had it been also the government securities in general, the argument would have been similar. So there are these are the following roles that can be played by treasury bills in money supply control. One can be in the context of open market operations. So in open market operations, RBI can sell treasury bills to the commercial banks. Okay, when RBI sells these to the banks, it will lead to less liquidity with banks, hence lower money supply. You can write it in more detail, I'm sure. Less liquidity with the bank will mean the banks cannot give as much of loans as earlier. When they're not giving as much of loans, the interest rates go up. Interest rate goes up, the money supply tend to fall because the loan demand is relatively lower. I expect you to fill in the blanks from the basic thing. Then you can also talk about in repo market. In repo market, treasury bills can be used by banks as a security for short-term loan. As a security for short-term loans from RBI. So that is another way you can argue how the treasury bills can be important. Okay. Depending upon other things, you can bring more things, but I think these are the two main roles that you can talk about. As far as the word examine is concerned, you can basically argue that treasury bills are fundamentally short term. Therefore, whatever impact we are going to get will be in the shorter term only. Treasury bills have maturity of 91 days, 182 days, maximum 364 days. And that is why the longer term impact on money supply cannot be expected from there. Okay. And you can also say that there are other monetary policy instruments also through which money supply can be well controlled, like CRR, cash reserves ratio, is not involving treasury bill. This is just the cash which the banks need to keep with the bank. That has a much powerful control over money supply than the treasury bills. So you can also compare treasury bills with some other monetary policy instrument. Okay, one more thing that you can add in the roles of treasury bills is that it can be kept as a part of SLR. Statutory liquidity ratio includes a number of liquid assets with the banks, mainly the government securities. Since treasury bills are also a type of government securities, they can keep it in SLR, and RBI can change SLR to impact money supply. Like higher SLR will be lowering down the money supply. In that case, the banks may hold more treasury bills. So I think that's more than enough for a 10 marks question. Moving ahead. The last one of the compulsory question was, write down the major assumptions behind the neoclassical loanable funds theory of interest. Okay, so this is again a question on the classical macroeconomics. Somehow this year classical macroeconomics is more into it. The question is just asking assumptions. So you have to be relatively brief on that. In assumptions, you can talk about The facts like the supply of loanable funds is provided through the savings by public, mainly the households. Then you can talk about demand for loanable funds is made by firms for investment, and also if you wish you can write it separately or in the same point, also by government to finance its deficit. Okay, then separately you can even write that for this demand for loanable funds, the bonds are issued. Bonds are being issued by both the firms as well as the government. The purpose is different, however. Okay, then you can write a couple of other assumptions also, like you can talk about that savings are directly related to the interest rates. Investments are inversely related. Investments are inversely related to the interest rate, and the government borrowing, according to the neoclassical theory, is independent of interest rate. Okay, because government will have to borrow no matter what is the interest rate if they are in deficit. The question is not asking to discuss the theory, but still if you have some space left, what you can also do is that you can briefly show a graph of that. So basically in the graph you can keep interest rate on one side, loanable funds on the other side. You can draw a savings curve like this, you can draw an investment curve like this, and if the government is also borrowing, given that there is a T level of tax revenue also, then this will be shifting to right. You can call it as I plus G minus T. It is like investment for plus the government expenditure minus taxation. In that case, the equilibrium will be here. Accordingly, there will be some equilibrium interest rate, call it I1, and some equilibrium amount of loanable funds, call it L1. Okay, so this is not being asked in the question, by the way, but there is no harm if in the end, after the assumptions all you have written, you put that also briefly, so that this is in a way graphical representation of assumptions only, and from there the equilibrium interest rate comes in. Okay, so that should have been more than enough for the question, although in my class I discussed the loanable funds in much more detail, as in what will be the impact of fiscal policy or what would be the impact of some crisis situation on this equilibrium. That is not being required over here. Going further, we come to question number 2. Okay, the compulsory questions are over of the first section. Second section will come to. 2A was derive Pareto optimality condition in production in 2 commodities, 2 factors, 2 producers framework. Show that Pareto optimality does not guarantee for equity. You had 10 plus 10, 20 marks for the entire question. Now, although it is 10 plus 10, it appears that first one will be needing more time overall, but still you should try to devote more or less equal thing. Pareto optimality condition in production in a 2 commodity, 2 factors, 2 producers framework. You should have 2 things in your mind. One is, there are 3 conditions of Pareto optimality. The 3 conditions can be given as efficiency in exchange or consumption, where we talk about, say, MRS, the marginal rate of substitution of some good X for Y, say by the consumer 1, equal to MRS XY by the consumer 2, okay, and so on. If there are more consumers, then accordingly that should be the case. Then we have efficiency in production. Production as in using the factors of production. There are 2 factors of production. You can do one more thing before writing these 3 conditions. Since it's a 20 marks question, you can begin with brief assumptions also. In any case, that will be needed. Assumptions as in there are 2 commodities, it's already written. Okay, call it X and Y. There are 2 factors of production, call them labor and capital. 2 producers, give them also some name, say A and B. Okay, that would be keeping it in a perfect way. Don't forget to write the assumption of perfectly competitive market, because these all conditions are going to be true only when there is perfect competition. During imperfect competition, this Pareto optimality needs some other conditions also to be met. Okay, so with these words in mind, efficiency in production will mean MRTS, marginal rate of technical substitution of labor for capital by some producer, let's say A, is equal to MRTS LK with respect to other, which is B. That is second condition. The third condition is efficiency in product mix, or sometimes we also call it output mix, something in other words, where we talk about MRPT, marginal rate of product transformation of X for Y, being equal to Px upon Py, which is the price ratio. This MRPT is nothing but the slope of PPC, the production possibility curve. Okay, so had it been a very quick, short answered question, you could have done this also as Pareto optimality condition, but being a 20 marker, you can go further, because your second part of the answer may also be somewhere connected with that particular part. Although in the question they are not specifically asking on the consumer side, so you have to focus more on the factors of production and the producer's framework. Graphs have to come in paper 1 wherever required and wherever there is some option of bringing it in. So what kind of graphical interpretations can be done? For this efficiency in production, you can show this in the production Edgeworth box. All of you must be knowing about the Edgeworth box from the general equilibrium. In production Edgeworth box, this condition will be there on the contract curve. Okay, when you are stating the assumptions like 2 commodities X and Y, it is also preferable to write down that one is labor intensive, other is capital intensive. Why am I telling that? Because that will ensure a particular nature of the contract curve here. Suppose I take X as labor intensive, Y as capital intensive. In this case, then the production Edgeworth box is always drawn in this manner. Suppose that we are talking of 2 producers A and B. These are labor and capital. Then the production Edgeworth box will be appearing like this. Basically, it will be all the points of tangency of isoquants. Tangency of isoquants here mean the different levels of X and Y. You can name it as X1, X2, X3, X4, X5, and similarly Y1, Y2, and so on. These are the different levels of production. Okay. You must have done that all points of contract curve are Pareto optimal, because Pareto optimality by definition means there is no way to make someone better off without making others worse off. By that logic, all the tangency points are Pareto optimal over here. In fact, you will also see MRTS LK is same at all these points. So MRTS LK for from one producer's perspective will be same as the other. So that is also there. Then in order to derive the Pareto optimality condition graphically, you can also convert this into the production possibility curve. When we convert this into production possibility curve with two axes x and y, the goods, the production possibility curve looks like a concave curve. Suppose these points were named as P, Q, R, S, T, then these points will be over here also. Okay, these things will be here also. Basically, we have mapped this on this part and all the points will be Pareto optimal over here. Okay. And actually the question can be answered here itself because they are not talking about the price ratio. Still, when we do the overall discussion of Pareto optimality, then we say that suppose price ratio is such that Px upon Py passes through some point, let's say R. Suppose this is my price ratio of x upon y, Px upon Py. Then what we can do, we can draw a consumption Edgeworth box from that point, having some amount of x and y available to two consumers. There can be production Edgeworth box. Although this is not being asked in the question directly, I think the second part can be started from there, where they say show that Pareto optimality does not guarantee for equity. Equity is a term which is often referring to the fair distribution. Fair distribution, actually fair distribution can be in many terms. Fair distribution of products or commodities, fair distribution of income levels and so on. Okay. Equity is a wider term that we talk about. In order to discuss equity, I don't think you'll have to talk only about producers. Okay, although equity can be anywhere, even among the producers, the equity is there because no producer is losing out anything on these particular terms. It is telling Pareto optimality does not guarantee for equity. Can you see there are two ways in which you can say that. In the production Edgeworth box, you can say that Pareto optimality will be also a point like this, where we started, where the producer A is producing nothing and the entire production is by B. Okay, but this is clearly not equity. Or the point like B, where producer A produces all the products, B produces nothing. So it's like there is unfair distribution of output produced by the two producers. So there are two ways in which you can say Pareto optimality does not guarantee equity. One is here. You can say that even if one producer is producing a lot of one product, another very less, then also situation is Pareto optimal but not equitable. But a better way to talk about it is in consumption Edgeworth box. This is the consumption Edgeworth box over here, where we are assuming there are two consumers who are consuming certain amount of x, call it x1, and certain amount of y, call it y1. Here also there will be a contract curve, which is nothing but all the points of tangency of the indifference curves. Okay, these are the ICs. You can call them I1, I2, I3, and similarly on the other side you can give it some other names over here. Okay. So when you are giving I1, I2, I3, since we had talked about the consumers being two, you can put some notation for that part. So these all are Pareto optimal again. These all points are Pareto optimal on the consumption Edgeworth box contract curve, but it is clearly not equitable. Like consider this point as O, the origin. It is at point O that the consumer 1 is consuming nothing. Okay, there is zero consumption and the consumer 2 consumes everything, the entire x1 and y1. This is Pareto optimal but not equitable. The other extreme is here, where the consumer 1 consumes everything, x1 and y1, 2 doesn't get anything, which is also not equitable. So you can give both kind of examples in order to justify that. Okay. Although I still feel that the second part of the answer will be relatively brief, But then the graphs that you draw for the first part can also be used for the other one. Okay, that is what you can do over here. Let's move to the next one, B part for 15 marks. Write down the behavioral assumptions of or used in Marshallian and Walrasian approaches of market stability. Show that the two approaches become conflicting when both demand and supply curves are positively sloped. Okay, the first part was talking about the behavioral assumptions. Okay, how are they different? Basically, in case of Marshallian analysis, it is always a partial equilibrium analysis, while Walrasian analysis can be general equilibrium. Actually, had it not been a separate question, then we could have avoided this also. Why am I telling? Because in market stability only this argument is not needed. It is correct that Marshall is more in the context of partial and Walrus general equilibrium. That is not needed in showing stability. In stability, the other part which is more important is that Marshall goes for quantity adjustment behavior, while Walrus goes for price adjustment behavior. You can also say that in slightly mathematical language, that in case of Marshall, quantity is independent variable and price is dependent on that. Okay, according to Marshall, the producer first decide how much quantity is it going to sell, and that will determine the price. It is opposite in case of Walrus. Here, price is independent variable while quantity is dependent. Normally when we discuss economics, like for the general purposes in GS, we generally think in Walrasian context. Normally we think that it is price which will impact the quantity and not vice versa. But Marshallian analysis, which came much before Walrus, had claimed the opposite. This is the main difference in behavioral assumption. So you may not have many points to write upon, although I'll give you one more point. But I think you should focus mainly on the second point over here. This is the main reason why sometimes there is conflict between Marshall and Walrus in showing the market stability. There is one more thing that you can say, and ideally we get that conclusion by the time that we end this analysis, but in question you can answer it separately also. A third thing that you can talk about is that Marshallian analysis is more applicable in long run. It is more applicable in long run, while the Walrasian analysis is more applicable in short run. That will fit also through examples. Actually, if you wish, you can give examples as well, because the first part is having the greater weightage over here. Quantity determining prices may be possible in longer run. For example, when the producers, say farmers, have already surplus production, the quantity can impact the price. The price of their product can fall. Walrus is more of short run, where right now when there is a price change, then consumers or producers are behaving accordingly. And then the second part of the question was show that they become conflicting when the demand and supply curves are positively sloped. This is just one of, in fact, 2 of the 6 cases. There are 6 cases which we can discuss, which we do in the class in detail, of Marshallian Walrasian stability. In the exam, you are being asked on 2 of them. Why 2? Because there can be two cases where demand supply curves are positively sloped. One, when demand is steeper, supply is flatter. Other, when supply is steeper, demand is relatively flatter. So let's look into that in order to complete the second part. So we have quantity and price. Suppose we talk about a demand curve which is steeper and supply curve which is flatter. They are not telling that which is flatter, steeper, they are just telling they are positively sloped, but you can take it up both way. How do we show the stability? The trick is very simple. Get the equilibrium quantity and price, call it P1, Q1. For Marshallian stability, we start with any quantity before Q1, say Q2. And at Q2, we find that the supply price is greater than the demand price. The language of Marshall is slightly different than what we commonly talk nowadays. And whenever supply price is greater than demand price, what does it mean? That the minimum price that producers are ready to accept is more than the maximum price the consumers are willing to pay. So what will the producers do? Since they are not getting what price they expected, okay, the supply price is higher than the demand price, they will actually reduce production. So there will be a movement away from Q1 and vice versa. If we talk about Q3, the demand price is higher, supply price is lower, means the minimum price that consumers are willing to pay is more than what is the maximum that producers need. So by that logic, producers will be happier, they will produce more. But then again, the movement is away from equilibrium. This is a case of Marshallian unstable equilibrium. This is a case of Marshallian unstable equilibrium. What will Walrus do here? Walrus will change the price from P1 to a price like P2 or P3 to analyze that. Okay, so you can take that way. Suppose price is P2, then what is happening? There is excess supply of that good, supply is more than demand, or you can say there is excess quantity being supplied. What happens during an excess supply that most of you should be knowing? The price tends to fall. When the farmers have excess supply of some grain, they will be ready to sell it at a lower price. So there is a movement towards equilibrium. Vice versa at P3, there is excess demand, prices increase towards equilibrium. Hence, this is a case of Walrusian stable equilibrium. This equilibrium is Marshallian unstable, but Walrusian stable. Hence, you have shown that it becomes conflicting. Although if you have very less time, you can leave it here also. Okay, but ideally when they are talking about the positively sloped, there is another possibility also. The other possibility is that the supply curve is steep and the demand curve is flat. That is also possible when both are positively sloping. And then you will see, I am not drawing the entire part, just showing you that when we do the Marshallian analysis, Q1, Q2, Q3, etc., then at Q2 there is excess demand price. Okay, excess demand price that the producers are getting already more than what they expected, so they will produce more, movement towards equilibrium. Here there is excess supply price, so they will produce less. So this equilibrium is Marshallian stable equilibrium. And if you look at from the Walrus side, if you change it from P1 to P2 or let's say to P3, what will be the situation? At P2 there is excess demand of quantity. Okay, at P2 there is excess quantity being demanded. From excess quantity demanded, prices go up. Okay, therefore there will be a movement away from equilibrium. Similarly, here there is excess supply, the prices fall. There is movement again away from equilibrium. This is Walrusian unstable equilibrium. As you can see, in both cases, Marshall and Walrus are conflicting in their approaches. Okay, so that is basically about this question. Let's go further. The third part, describe the short run and long run equilibrium of a firm under the monopolistic competition. Okay, 15 marks question. Basically, you need two parts to answer. The first one will be easier because in short run, the short run monopolistic competition equilibrium is similar to monopoly. In short run, the monopolistic competitive firm behaves in a similar way as monopoly. So you can just discuss how the monopoly equilibrium is there. In a monopoly, there is typically a demand curve, although you can name it slightly differently here. Generally in monopoly, we just call it the demand curve. Here you can more formally call it, say, the perceived demand curve. Remember, we did it in the first part, because in monopolistic competition, always there can be two types. In short run, we will not talk about planned demand curve because we are not explaining the change in price and its impact. Corresponding to a demand curve, there is MR also, the marginal revenue. And I'm sure all of you know that the equilibrium is where MR is equal to MC. This is the equilibrium. You can do one more thing. You can draw an average cost curve, okay, in such a manner that the minimum of average cost is being cut by the marginal cost. So you have to make sure that it should cross it from minimum. This is just to show that generally in this equilibrium, the monopolistic competitive firm will be making profit. Okay, this rectangle will be the profit or supernormal profit that the firm can make. And that is the fundamental difference between short run and long run. In long run, the monopolistic competitive firm may not be able to, rather will not be able to make profit in the sense that there is a competition. Okay, although monopolistic competition discussion has been mainly done by Chamberlain. Chamberlain discusses three models. Okay, sometimes in this exam we have seen questions coming on specific model. Okay, here they have not asked. Okay, generally telling you what are the specific models. One in which there is only price competition, meaning thereby the monopolistic competitive firms compete only by changing prices. Second, where there is no price competition, only entry of firms are allowed or exit. And then the third one, which is combination of both. Okay, sometimes they have asked question which is specifically telling which one you have to discuss, but here it is not. So you have freedom. You can discuss any one of the long run equilibrium model. But if you ask me, it is better to do the third one, although the slightly complicated, agreed upon. The first and second are easier than the third one, but that will leave no stone unturned that you have left anything. The examiner cannot say that, okay, you left the one aspect of the monopolistic competition. So they are not giving any clarity. So in a way, the freedom you get is that you can discuss any model. You should ideally discuss the third model where there is both, in long run where there is both price competition among the monopolistic competitive firm and entry and exit allowed. Entry and exit of firms being allowed. Actually, the whole discussion is graphical. If you can do a correct graph of it, you will get marks easily even if you write very less, because the graph itself is slightly complicated. I'm kind of showing you how do we do the long run equilibrium of a firm under monopolistic competition. For this, you should take a slightly bigger space also. Here you have Q, the quantity being sold, the P. Okay, keep your average cost curve slightly extended. Okay, we talk about it again with Q and P. We can talk about long run average cost in this manner, and then we start with drawing a perceived demand curve. which is relatively flatter. Give it some name D1, D1 dash. Okay, I'm being a little quick because in the class I devote almost half an hour or more also to discuss this graph. Here we have too many things to discuss, can't devote that much of time. And then we begin with a situation where the proportional demand curve is somewhere to the right. Okay, and that is why the initial situation is here. Okay, I'm not naming these things over here. The situation starts from here, and what we can see is that since the average cost is below the demand curve, the firms are earning profit. Clearly at a point like this, give it any name, say A, the firms are earning profit, supernormal profit. So that supernormal profit will attract more firms to enter. We are allowing for entry of the firm. The moment firms enter, the proportional demand curve shifts leftwards. Proportional demand curve is what? The market share. When more firms enter, the market share decreases. So it keeps on shifting. Till when will it shift? Till it comes and intersects the point like this. You have to make sure that these two lines should be parallel. D1, D1 dash and D2, D2 dash. And the firm will stop only here when the profits are no longer there. But this is not the final equilibrium. At this point, suppose the price is P1 and now the firm reduces the price to P2, hoping that it will be able to sell, let's say Q1. Remember, we did it in the first part also, that there is a perceived demand curve where the firm hopes to sell a relatively higher amount, but it will end up selling only less, call it Q1 dash. Okay, so what will happen? It didn't get the actual profit, rather than it will end up in loss. You can see at Q1 dash, the cost is higher than the revenue, and this quadrilateral is a loss for them. Okay, but unrealistically in Chamberlain's model, the firms are assumed to be myopic. Myopic means they don't learn from here. Okay, even if they sold much less, they don't learn from here. And still they expected that once they reduce the price further, they will be able to sell more. So it is due to this reason that the perceived demand curve keeps on shifting down, say from D1, D1 dash to some other point, call it D2, D2 dash. And this continues till it is tangent to the LSE. Okay, something like D3, D3 dash. Okay. Actually, this is going to be our equilibrium, but the story doesn't end here, in the sense that even at D3, D3 dash, the proportional demand curve is here. Okay, which means that still the firms think that by reducing the prices, they will be able to sell more. There is also a possibility that the firm's perceived demand curve falls further down, say to D4, D4 dash, and clearly then they realize that they are in loss. Okay, the demand curve is entirely under the LSE curve. They realize that they are in loss, and then there is a movement up. How the movement up? When the most loss-making firms start leaving the industry. Okay, by the time the perceived demand curve is much down, the loss-making firms start leaving the industry. So that would also shift the proportional demand curve rightwards. Until when will it be shifting? Till the time that it crosses the same point where it was tangent. Call it D3, D3 dash. Okay, you can name it as E, which is the equilibrium. And you can do one more thing. Vertically below this point, you should draw the marginal revenue for D3 in such a manner that it is where the marginal cost is crossing. Suppose this is our minimum of LSE. So marginal cost will be like this. LMC, long run marginal cost. Make sure that your marginal cost and this MR3 should be crossing at the same point. Call it in whichever way you want. So this is MR3. This is where MR and MC is equal. Hence, the equilibrium will be here in long run. This is the long run equilibrium. The long run equilibrium where both the proportional demand curve and the perceived demand curves intersect, plus the perceived demand curve is exactly tangent to the LSE. Can you see what is the relevance of tangent? Tangent means there is no profit left. Okay, there is no profit left over here. That is when there is no incentive to change their prices or demand curve. Okay, fine. It is good that you write it a little also. You explain what is happening. As I orally told, I didn't write it here. But I feel if your graph is conceptually correct, and even if you write it briefly, because it's a 15 marks question, you have 2 parts to answer. I can understand the time limit, and the graph is not very easy. Okay, I drew it quickly, but typically many students struggle to draw this. Hence, make sure that you devote more time to drawing the correct graph. Explanation can be brief, that will be slightly permissible. Okay, let's move further. Now we are in question number 3. Explain the concept of underemployment equilibrium with graphical illustration. Graphic is wrong, graphical illustration. Why full employment cannot be reached automatically in Keynes' approach. Analyze. Basically, this is a question on Keynesian macroeconomics, but again, slightly unusual question. This type of question is not very common in the exam, and that is why I would rate it as slightly difficult part of the exam. Obviously, there are more than one ways of answering this, but it is saying that it should be graphical illustration, so the graphs must be there. As I told you, there are different ways of answering the same question. It is not necessary that you answer in the same way. In this case, I would say you can begin with ISLM analysis. Although the graph I am drawing may appear a little complicated to some of you, but I think this is a quick way. Remember, in ISLM we trace interest rate and income relationship. Okay, and IS curve is downward sloping, LM curve is upward sloping. ISLM is the most modern way in which the Keynesian analysis is done. Let's give it some name also, call it LM1. Okay, and in this case there is an equilibrium at E1, some equilibrium output Y1 and interest rate I1. Okay, now do one thing, draw a kind of a multiple section graph in order to see why this can be an underemployment equilibrium. Let's give them some name, call it as 1, call the second panel as 2. In second panel on both axes we have Y. Basically we draw a 45-degree line segment here in order to just trace this Y onto the other graph. We just take this Y into our third graph, which is of production function. Y on one axis, labor on the other, or employment on the other. So we can say that for this Y1 level of output, N1 level of labor needs to be employed. This is my production function. I'm sure all of you know the production function typically looks like this in the second stage of production. And then in another panel, draw the labor demand and labor supply curve. Call them ND and NS, or whichever way you want to name it. And then you will see that, then you will be finding that ideally this equilibrium may or may not be at the equilibrium of this. Basically what we are telling is that maybe full employment output was here, YF, not at Y1. Okay, if full employment is at YF, then this equilibrium in labor market, give it some name if you wish, will be associated with NF labor, but actually the equilibrium is N1. That is what Keynes was telling. Classical said that economy is always at full employment. Keynes said no, not necessary. It is possible that the equilibrium is before the full employment level. In that case, can you see what is happening here in the labor demand supply curve? Here we have real wages. Here we have employment again, the same thing. The equilibrium real wages, okay, the equilibrium real wages in this case is W by P F in full employment, but actually in the equilibrium we have W upon P 1. So the ISLM intersection or Keynesian equilibrium is where the real wages are higher than what should be in the full employment. Now, it's a good way to compare it with the classicals also. Had it been classical theory, what would have happened? At this higher real wage, there would have been excess supply of labor. Due to excess supply of labor, the wages would have fallen. The cost of production would have fallen for the producers. Okay. And as the cost of production would have fallen, they would have been able to even employ the wages at a lower real wages. Okay. Hence, the equilibrium could have been automatically reached. That is what classicals claim. That even if you deviate from the full employment level of output, the wage price flexibility ensures that you come back to full employment. Keynes says no. Okay, so the second part is asking that also. Why full employment cannot be achieved automatically? Okay, basically the answer is very brief. Why full employment is not reached? Because of rigidity of most nominal variables, mainly wages, but also prices, etc. Wages are clearly rigid, particularly rigid downwards in the Keynesian model. So Keynesian model says that this W upon P1 will not automatically go to W upon PF because the wages are rigid, the prices are also rigid. And that is how you could have explained. So the first part was mainly why there is underemployment through the graph, and then you can explain why full employment can't be reached. Since the second part is also 10 marks worth, okay, although they are not asking, ideally you should write Keynes versus classicals. Because when they ask why full employment cannot be reached automatically, you can briefly write why in classicals it reached automatically. So in classical theory, there is assumption of wages and prices being fully flexible. Okay, and that is the reason whenever there is a real wage higher than the full employment level or lower, there will be automatic adjustment. Here it will not be taking place. And that is why the economy will remain under some underemployment equilibrium. And through this, although not being asked here, through this Keynes favored the role of government. Okay, because underemployment cannot be automatically handled. The role of government is very important. Like during the Great Depression, that is how Keynes justified the strong role of government, and that is how to some extent the Great Depression was resolved also. Okay, so again I am not writing everything, but hope you, when you get the basic arguments correct and what you have to write, then that doesn't remain a big deal. Let's go further. The B part of it. Okay, it was a numerical. In economics optional, there are some numericals which are often asked, although this was the only numerical asked this year. Fine, there may be some typing issues over here, so I'll take the original question paper and take it from there. The question had said, calculate the equilibrium national income Y and interest rate R by using an appropriate macroeconomic model from the information given below. Appropriate economic model, as in they are not specifying which model. Okay, it is again up to you to decide which model is appropriate. Let's see what is the information. They have given a savings function, they have given a tax function, investment function. Okay, this is 0.2y and again 0.25r. It's okay, we'll write it down in any case. money demand function, which is L equal to, it is L equal to 0.4y minus 0.5 R. And aggregate money supply is 40 crores. Okay. So what is the hint that you get? Well, anyone who has done the preparation well can easily guess that they are telling you to talk about the ISLM. This part is your product market of ISLM and the other part is your money market. In ISLM, we talk about the equilibrium in product and money market simultaneously. But you cannot just memorize ISLM and answer such a question. That's the beauty of the numerical. You'll have to derive ISLM here. That is why there is no point just memorizing those things, but also remembering the logic behind that. ISLM, let's start with IS first, which is related to the product market. In an IS equation, we can talk in two ways. Either you can say Y is equal to C plus I plus G. Okay, national income is equal to consumption, investment, government expenditure. We assume closed economy throughout the discussion. And the other way to write it is S plus. The other way to write the same thing can be S plus T is equal to I plus G, because Y minus C is S. Okay, and if we bring taxation in our discussion separately, then it can be written also as S plus T equal to I plus G. We'll be using that second formulation here because information has been given in that way. Okay, so let's see the numbers because it's not very clear over here. I'm taking from the original question the numbers over here. In this case, G is not written, so we'll take it as 0. So G is clearly 0 because it is not written. So ignore this part. This is not here. It will be just S plus T equal to I, for which we have information already. So let's just write it down formally. For IS equation, we'll write (20 minus 0.25 R), which is nothing but my investment function, equal to S plus T. S is what? Minus 40 plus 0.5 Y minus T plus 0.25 R. Now this T function is also given, so just replace it, which is 20 plus 0.2y. When you simplify this, you should be getting 20 minus 0.25 R is equal to minus 50 plus 0.4y plus 0.25 R. And then when you simplify that, finally the equation of IS should come out to be, after rearranging that, it should be coming out something like this: 0.5 R equal to 70 minus 0.4 Y. What you can also do, take 0.5 to this side, but actually it hardly matters. Why am I telling that? Because even LM curve will come in such a manner that it is like that. So we'll leave it here. Similarly, we get the LM equation. LM equation means what? LM equation means where money demand and money supply is same. MD equal to M. MD is given over here, the money demand function, which is 0.4y minus 0.5 R will be equal to 40 crores, which is the money supply. Rearranging this will give you 0.5 R equal to 0.4 Y minus 40. Call it equation number 2. Now even visibly, if you look at 1 and 2, you will see that both the coefficient of r and y are same. In fact, for this it is from minus sign, here it is with a plus sign. So just by looking at these two, you can kind of cancel out this. When we solve the equation one on one, we can cancel out this and then add these two, which will give you r will be equal to 70 minus 40, 30. So the interest rate is 30%. That is what you needed. You have to find out equilibrium interest rate as well as the national income. Put this value back into either IS equation or LM equation to get it. You should be getting that to be equal to, if you put it back, you should be getting y to be equal to 275 upon 2. Just confirm it. It's a elementary mathematics I am not doing over here. Put this 30 over here, this will become 50. Okay, this is 0.4y. So 0.4y will be 70 minus 50, which is 200. And then you can, so basically this 0.4y will come on this side and this will go on to the other side. 5 3s are 15, it will be 15 basically. I'm so sorry. So it will be 70 minus 15, 55, okay. And then 55 upon 4, 50.4, which will be giving you this amount. You can also put it in decimal terms if you wish. So this gives you first part. The first part was about equilibrium national income and interest rate. Second part says how will it change when money supply is increased by 20 crores. No big deal. Instead of 40 here, write 60 and resolve that. Okay, so instead of 40, if you write 60, then also you'll have the similar equation, except here it will be minus 60. Okay, nothing else will be changing over all. And by that, if you solve for it, you will be getting it to be equal to. So then also 0.5 will be r, that will be 60. So it will be giving you basically 70 minus 60, which is 10. So if the money supply is increased by 20 crores, then equilibrium R will be equal to 10. Earlier it was 30, now it is 10. And what will be the equilibrium national income? Put 10 back over here. This will become your 5, 70 minus 5, 65. So 65 upon 0.4, which will give you 325 upon 2. Equilibrium Y will be 325 upon 2. Okay, although they are not telling you, but it would be also good to interpret it briefly so that your understanding remains quite better over here. What happened was that when money supply increased, basically LM curve shifted to right. And when LM curve shifts to right, then equilibrium interest rate should fall and equilibrium output should increase, which is expected. Okay, if you don't have time, you can leave it because they are not asking it. But without drawing it to scale, you can say what is happening in this numerical is we have an IS curve, we have an LM curve, and then in the second part, money supply increase, so LM curve shifts right. With the rightward shift in the LM curve, what will happen? The equilibrium interest rate falls, look back into the figure, and the equilibrium output increases. So this is one way to also confirm that you are not doing something drastically wrong in the numerical. Okay. Let's go to the next question. Critically analyze the classical theory of interest. Somewhat repetitive actually, because they had already asked about loanable funds theory. Now, there are two things to claim here. Within classical macroeconomics also, money was not directly talked about, but interest was talked about by the early classicals also. For example, the earliest classical theory of interest was given by Ricardo and Hume. It is not very often discussed because it is too simplistic. Okay, Ricardo and Hume also talked about savings and investment being dependent on interest rate, just like the loanable funds theory do. But in the original classical theory, they didn't spend too much of time on the issuance of bonds or how the firms are different and government is different. They universalize savings investment too much, as in savings can be done by anyone, investment by anyone. So that way, we do not have much graphical way of interpreting the classical. But since the word was classical theory of interest, you can start with Ricardo, Hume, etc. and then say that the main limitation of them was, that it was too simplistic a theory, or you can say there was not much role of financial markets, etc. here. The financial markets, including the bond market, etc., was not being highlighted. Clearly then you can come to the loanable funds theory. Even if you just write loanable funds theory, it's okay. But technically speaking, it was given by the later classicals or neoclassicals. The names like Marshall, Wicksell, etc. comes with that. In another question, I had discussed the assumption of loanable funds theory and also brief what will happen. So in a way, it is a similar question being repeated, but not entirely, because the word is also critically analyze. Critically analyze is telling that you also have to talk about to what extent this theory is actually depicting the reality and to what extent it is not. So for that, you can compare it with the Keynesian theory. Compare it with the Keynesian theory. And which Keynesian theory? The liquidity preference theory. So within the liquidity preference theory, Keynes more clearly talked about the different types of money demand, like transaction demand, precautionary demand, speculative demand. Money supply was assumed to be given in a exogenous manner by the central bank. And don't forget, the Keynesian theory is also bringing in the role of product market in the interest rate. Actually, it was neo-Keynesian. Okay, original orthodox Keynesian theory didn't talk much about that. But when we talk about ISLM, which is often coming under the neo-Keynesian one, that is where we also saw the ISLM. So you can very briefly talk about that. It's a 15 marks question, so I know you don't have enough space to write also. But even if you briefly discuss ISLM and tell them that look, in the ISLM context, interest rate is dependent on not just money market but also product market. It kind of shows your good understanding of multiple schools of macroeconomics, ranging from early classicals to neoclassicals to orthodox Keynes to neo-Keynesian. Okay, kind of 4 interrelated schools have been taken up in one way, and obviously there is not much beyond that you will be having the time or space for. So that is how you can handle such a question. Let's go further. This was question number 4a. Describe mechanism of credit creation by commercial banks and its implications on money multiplier effect. Analyze some limitations that can jeopardize the implications on multiplier effect. Although it's a simple question, a very traditional question, but you need to be a little careful in answering this. Actually, money multiplier is known to more or less everyone, even those who do money banking as a part of GS, and clearly, so by multiplier effect, they are clearly referring to the money multiplier, where we talk about that how can some H amount of the high powered money through the central bank will impact the money supply. Okay. There are 2 ways in which we do multiplier effect. We just take some numerical value of CDR, RDR, etc., the currency deposit ratio, reserve deposit ratio, and then putting those values in the example, we calculate what is money multiplier. Okay. But generally, in optional subject, we take not the numerical values but the concepts. Like we'll take small c as CDR, small r as RDR, and then that is how we show the money multiplier. Money multiplier comes out to be approximately equal to what we call 1 plus C upon C plus R. I am not deriving it because this is a traditional part of it. C is CDR here, currency deposit ratio, R is reserve deposit ratio. And here we are assuming that there are no time deposits. So clearly this is a simpler version of money multiplier. If you go by more complicated one, unless it is being asked, you may not do that. You can do that here also. Then your denominator will be slightly different. Then it will be C plus R into 1 minus T, small t, where that T will be the proportion of time deposits which is being taken up in order to create the money supply. So that is one option. But I feel the main focus of the question is elsewhere. The question is asking mechanism of credit creation by banks has implication on money multiplier, and that is also only for 10 marks. Other one is for the other part. So I think here you should be as brief as possible. So one way that you can say, you can pick up the variables from here itself and discuss how these variables determine the credit creation. Okay, like generally when reserve deposit ratio is, not generally, when reserve deposit ratio is higher, then credit creation is lower, because when banks keep more reserves, they cannot give as much of loan. Opposite for currency deposit ratio is the case. But since it is an optional paper, it is better also to talk about a formal bank credit multiplier, because they are clearly asking mechanism of credit creation, by the commercial bank. They are not asking in a general way credit creation, but the exact mechanism, for which you also need another multiplier. Remember, there are many multipliers: deposit multiplier, money multiplier, bank credit multiplier, etc. They are not telling you formally, but you can do so. So in bank credit multiplier, in order to derive that, what you can do is that you can take up bank credit, call it BC, as equal to investments of the banks, call it I, plus the loans and advances. Call it LA. So BC or bank credit is equal to I plus LA. And how do we derive the multiplier typically? In case of multiplier, we talk about the fact that the overall deposits DD must be equal to R, the reserves, plus the bank credit, as in the banks will be using their deposits either to keep reserves or to give the bank credit, which can be given as R plus I plus LA. Okay, and then from here you can write that BC is equal to DD minus R, which will be equal to DD minus small r into DD. Small r is reserve deposit ratio, or 1 minus r into DD. Okay, this can be given as the bank credit, and this will give you finally the bank credit multiplier. If bank credit is equal to 1 minus r into DD, then you can say the BC multiplier will be, and let's also recollect that while determining this money multiplier, you will also get a relationship for DD, which is 1 upon C plus R into H. I am not deriving these things because these are easier. You can get it from any standard book on money banking. Okay, so this DD, demand deposit, is 1 upon C plus R into H. By that logic, you can say that the bank credit can be given as 1 minus R divided by C plus R into H, or bank credit multiplier the bank credit multiplier will be 1 minus R upon C plus R. The result that we get is not surprising. Okay, here also we are getting the result that lower R, higher bank credit, and also lower C, higher bank credit. Okay, makes sense also, because lower the currency deposit ratio, the banks have more deposits of ours with them, they can create more credit. Similarly, the lower reserve deposit ratio helps in both ways, it has a significant impact. So you can write this way more formally, that this is the mechanism of credit creation by the banks, and the same thing, lower R and lower C will also be leading to the higher money multiplier. Hence, you have shown that the mechanism of credit creation is having implication on multiplier effect. Okay. And then the question was, analyze some of the limitations that can jeopardize the implication of multiplier effect. There you can bring in any factor which can disturb the multiplier effect. Again, some things you can borrow from here itself. Since lower R and lower C are good for money multiplier, any factor that increases R or increases C will jeopardize the implications on multiplier effect. This is how you can systematically go. So, in the second part of the answer, you can say some of the limitations can be related to, say, factors increasing the value of C, the currency deposit ratio, like preference for cash in transaction. When we use more cash in our transaction, our CDR increases, banks don't get enough money to create credit. Okay, or you can say lack of financial inclusion. Lack of financial inclusion means less people having a bank account. Okay, if people don't have bank account, in any case that money cannot be accessed by the banks, and so on and so forth. Similarly, you can bring in factors increasing R. Here you can give any example of contractionary monetary policy. Like factors increasing R can be increase in CRR, cash reserves ratio, increase in SLR, statutory liquidity ratio, increase in repo rate. Since this is 10 marks worth part, you can be a little liberal. You can talk about as many limitations. In fact, even more you can write down from the monetary policy. Okay, what beyond CNR? Then you can talk about something else. For example, limitation can also be a situation called bank run. Bank run happens when most depositors withdraw the deposits simultaneously. When most depositors in the bank withdraw their deposits simultaneously, the bank can go in bank run. Clearly, in that case, the multiplier effect will be jeopardized. You can bring in more factors, but I think even if you elaborate properly and can possibly also give more example, that is more than enough for the 10 marks part. Okay, let's go to the next part. Distinguish between public goods and private goods. It should be. Let me read it from again the original question paper. Explain how market failure occurs in the case of public goods. Okay, so this was clearly done by me in the class also. It's an easy question. The first part was on the difference between the public goods and the private goods. So the private goods are rival and excludable. In consumption. Okay, rival means if I am consuming that particular good, the other person cannot consume the same unit. Excludable means the owner of that good may exclude someone who is not ready to pay. That is how most our goods are, private goods like food items, furniture, clothes, etc. They are all private goods. Public goods are exact opposite. Non-rival, non-excludable. Non-rival and non-excludable consumption. Examples are quite unique, like here you can think of defense as a public good, or sometimes we say a public information, law and order, and so on and so forth. The examples are more like a services. So that was the first part of the question, but the most the more technical part is second, how market failure occurs in the case of public good. The basic question, the second part, is trying to expect you to write on a problem in public goods which we call the free riding problem. Public goods often face a free riding problem. Free riding problem means since in public goods, and you can give other differences also here, like being non-rival, non-excludable, public goods are either provided for all or not provided at all. That is why in public goods we do not talk about quantity, we talk about quality. Free riding problem basically refers to the fact that since I know that public good will be provided for all or not for anyone, someone may tell their preference falsely. They can say that I don't need a public good, knowing very well that if it is brought in, they will also benefit. They basically try to free ride those people who are ready to pay for the public good. It should be shown graphically also, because it's 8 marks worth. If you have to show how the market failure occurs, you have to show it graphically. I'm discussing it in some brief way. Each and every part of the graph I'm not doing here, something that I do in the class in more detail. Here you can keep on one axis quality of public good, because in public good you can't talk about quantity, and on the other you can talk about the MRS, between marginal rate of substitution between the public and private good. Why are we taking that? In order to see how much of private good a person is ready to sacrifice to get some quality of public good. And it can be shown that the MRS between public and private good for each and every person kind of declines as the quality is improving over there. So suppose that there are two persons. Okay, for one we have this as MRS 1, and for other this is, let's say, MRS 2. How do we get the equilibrium in public good? By taking the sum of both. First MRS 1 plus MRS 2, okay, and then finding that point where it is intersecting the marginal cost of producing it. So this is the equilibrium in case of public good. In private good, we equate marginal rate of substitution. In public good, we add and then compare it with the marginal cost. That is how they are unique. Now, what is free riding? Free riding is like, suppose that the first person says that this is not my actual MRS. Then what will happen? The MRS 2 will be the overall MRS. Hence, equilibrium will be here, say at E1. Hence, quality of public good will degrade. Okay, a typical case of market failure come in that manner. Obviously, you'll have to write a little more on that, which due to time limitation, I'm not going into it. But this graph or somewhere in a similar way, if you have some other graphical interpretation, would be needed to show the market failure in case of the public good. Okay, any way that you can explain the free riding problem in a categorical manner. Let's go further. Okay, the third part of the same question was asking about difference between Fisher's and Cambridge cash balance approach in quantity theory of money criticism of each, which one is more relevant in the present context, justify. Again, I would call it one of the easiest question. They have been asking on QTM regularly and comparison of Fisher's and Cambridge cash balance approach. I'll be brief because I know this is something which is known to most of you. Fisher's approach is giving QTM as MV equal to PY, which is more like an identity. M money supply, V velocity of money, P price level, Y the income level or output level. The Cambridge cash balance approach starts with money demand given as some function of P and Y. And then later on they equate money demand with money supply in equilibrium, that is being equated. But end of the day their conclusions are similar, that money supply leads to higher prices, higher money supply. Question was, however, talking about difference. Okay, so you can give differences like Fisher's theory is more of a mechanical mathematical equation. Okay, while the Cambridge cash balance is a money demand theory, more economic in its nature. Okay, then you can talk about Fisher's theory doesn't talk about money supply demand separately. Cambridge equation talks about money demand, money supply in a separate manner. Okay, and then criticism of each when you are talking about, one is the general criticism of QTM, that inflation is not just dependent on money supply. There are supply side factors also which are important in this particular case. But if you go for criticism of each separately, then you will be needing some other theories also over here. Like you can talk about how Keynesian theory differed in terms of the giving money market, etc. And that will also be giving you some criticism. If you ask about which one is more relevant in the present context, I would say it is Cambridge cash balance, in the sense that having money demand and money supply separately and then equating gives us a more logical way of finding why money supply leads to higher inflation. Like you can illustrate through an example that suppose MD equal to MS and then MS goes up. Okay, then MS goes up. Then in order to MD to come at that level with same K and Y, because K is a behavioral constant which is not changing very often, Y is also in short run not changing. In order to bring MD to a higher MS level, P must increase. Okay, that is the argument given that why money supply increase leads to higher inflation or higher prices. So in the context of economic discussion, clearly the Cambridge cash balance which is more relevant over here. Okay, and you can give more arguments. I have written less on this because these two theories are known to, I am sure all of you, you can give them in more detail. Okay, like what is velocity of money, what is P, why Fisher says that V should be constant in short run, Y should be constant, that is why a direct relationship between them, and so on and so forth. But keep in mind, everywhere they are talking about difference mainly. So don't write each and everything, write those parts more which are different. Like here they talk of velocity, here they don't talk about velocity. They talk about a behavioral component K. But then finally K and V are also interrelated. Okay, so that is the reason why they are also somewhat similar. Okay, going further, we are now into the second section. Critically examine per capita GDP as a crude indicator of development. I would say again a very easy question. And very descriptive question. Critically examine as in why it can be taken as an indicator and why it is not. Okay, per capita GDP tells us about the average standard of living of a country, and that is also important. In order to look into the development aspect, we can say that. But averages have their own problem, and that is why you should devote more time to criticism over here. What kind of criticism you can give? Some of them I am writing down, like the per capita GDP can increase even if income inequality is higher. In fact, most of the countries which have faced higher income inequality have also faced the phenomenon of higher per capita GDP. Sometimes even poverty can be higher during the per capita GDP going up. Then you can argue there is no guarantee that per capita GDP, when it is increasing, there is no guarantee of similar improvement in human capital. In development, we should always talk about human capital also as an achievement, like education, healthcare, etc. It may or may not increase. There are cases where the per capita income is very high, like the West Asian countries, per capita income is higher, but the level of human capital development is not that good. In a similar way, you can bring other things like there is no guarantee of sustainable development. Rather, per capita income increasing is often harmful to the environment. The carbon footprint, etc., increases with the higher per capita GDP, and without sustainable development, it would be not correct to talk about the ideal economic development. So that is how you can handle such a question. Okay, let's come to the next one. You can even write down here that some of the sectors may not get equal benefit from higher per capita GDP, like agricultural sector in a developing country. It's a general question and you can innovate more on this, I'm sure. Coming to the second part. Explain managed floating and sterilized intervention for exchange rate. Basically, managed floating is a mix of market exchange rate and the managed one. Floating as in market and then the managed one. Time to time RBI can do it, or any central bank can do it by features like devaluation of currency or revaluation of currency, etc. So in managed floating exchange rate, devaluation, revaluation of currency can be talked about. Sterilized intervention is also somewhat similar in the sense that even in that case there may be devaluation, revaluation, etc. But so you can say managing the exchange rate without causing inflation. Particularly that is a fear under devaluation, that inflation may also be going up. So for that, what RBI or any central bank does is, when they are going for devaluation under sterilized intervention, they go for devaluation along with some contractionary policy, like contractionary open market operations. Like RBI, when it devalues currency, simultaneously it will also sell the government securities so that the liquidity can be absorbed and that doesn't cause higher inflation. Being a 10 marker, you had to be quite brief on that. No need to go too much in detail. Okay, going further. Discuss how carbon trading is helpful in reducing environmental degradation. Again, one of the easiest questions that they ask on carbon trading. First, define it briefly. In the definition, you can say that it's a market mechanism under which the less polluting sectors or even countries can sell the carbon credits to the more polluting sectors or countries. So carbon credit is like a benefit that is being given to the less polluting sector and like a punishment for more polluting. Each carbon credit is worth 1 million ton of the carbon dioxide, meaning thereby with each carbon credit we are offsetting this much of the carbon dioxide emissions. That is how you can say they are helpful in reducing environmental degradation. But there are many other things over here. In carbon trading, we are not just talking about the domestic trading. There can also be international. So there can be domestic trading, domestic carbon trading. But there are other mechanisms also like joint implementation. There can be clean development mechanism. In clean development mechanism or CDM, the developed countries can set up less polluting industries in the developing countries, and for that they can earn some carbon credit. So I think this much should be enough on the 10 marks. Although most of the times we would expect on something like carbon credit a question like critical appraisal, because there are a number of criticisms also that you can give. Why so far it has not been so successful? Okay, this was an interesting question, at least in wording. Higher tariffs do not increase employment, they just redistribute unemployed. Okay, do you agree with the statement? So you are being given freedom, you can agree or disagree. I would say it may be possible, it may not be. Okay, that depends on a number of factors. First of all, why this statement comes in. Higher tariffs benefits the domestic producers and harms the imports that compete with domestic production. You can take any sector and take that example. For example, if I talk of say steel making producers domestically, it will benefit the domestic steel companies and harm the steel companies which are exporting those steel to us, or we are importing it. So that way the domestic producers can create more jobs. However, there will be lesser jobs in these areas. Although I think since this question is too general, there is another way to look at it. One is employment, unemployment can be looked within a country. So these arguments when we give, this is at a national level. Within a country, what can happen? The question is not telling anything, so you can even talk about it at an international level. I hope you got it. At an international level, it creates job in the domestic economy. Creates job in the domestic economy, but reduces jobs in the exporting economy. The country from where that product was exported, there it may lead to job loss. So in that context, this argument seems to be correct. It's redistributing unemployed. So maybe from in my country I am creating more jobs, but in some other country I am creating more unemployed. But things are never that simple. There are other issues also. You can write them briefly. Like it also depends upon that is tariff being imposed on labor intensive or capital intensive commodity. If it is being imposed on capital intensive commodity, then it may not have much impact on employment in either case. Okay. If it is on labor intensive commodity, then it is likely to. There are other complicated things. It is possible that in the importing country, that product is labor intensive. Okay. And in the exporting country, it is capital intensive. If in the importing country it is labor intensive, there will be net benefit in employment, and vice versa. If the importing country, for them it is capital intensive and for exporting it is labor intensive, then it will not create many jobs in importing country but lead to more unemployment in the exporting country. So there are many possibilities over here. Being a 10 marks question, you don't have a lot of space to write upon, but I feel if you write it this way, that gives you a, there is nothing much you can draw in graph, etc. You can just argumentatively talk about that. And I think some of the fresh ideas should be rewarded only for you. Next one was explain how the equilibrium terms of trade are determined by using offer curves of the trading partners. One of the most standard question in international economy. Start with definition of offer curve quickly. I'm not writing, but this is very commonly available from any source. Offer curve is telling that at different levels of prices, how much a country is willing to import for certain level of export. Offer curve is like a combination of import and export of a country, and clearly in this case you will need a graph. So suppose that this is offer curve of one country, give it some name OA, and this is the offer curve of the other country, give it name OB. Okay, so here OA is offer curve of say nation 1 and OB is offer curve of nation 2. Axis is XY, XY are goods, and here you can say that the country, the nation 1 is exporting X, importing Y, the nation B is exporting Y, importing X. Okay, the books like Salvatore does it in a very rigorous manner, you can have a look if you have not, and then you can say that wherever the two offer curves intersect, we can draw a line from O, okay, let's call it OC, and this OC determines the equilibrium terms of trade. Terms of trade just means the relative prices at which the trading will be taking place. So this is one of the most standard question that they have given. Without any innovation, you can answer such question, and don't forget to draw the graph. Going further, discuss the elasticity approach and absorption approach for adjustment in BOP. Okay, again, not a difficult question, but you'll have to write a lot given that it's a 20 marks question. Don't forget that you have to define them, give assumptions, etc. also. What kind of assumptions are there? So let's start with the assumptions of the elasticity approach. Elasticity approach of BOP kind of assumes that BOP is impacted by trade flows as in export imports only, and not autonomous capital flows. The foreign capital inflows, etc., are kept out of it, which is unrealistic. In modern economies, you will see there will be a significant role of the international capital flows, but they are ignoring that particular part. That is the main difference also between the two. Okay, why do we call it elasticity approach? Because here the imports and exports, etc., are solely determined through exchange rate. So with respect to exchange rate, there is some relationship of import, export, etc., and that is how we name the concept as the elasticity approach. Basically, then you can go in detail and write down that whenever there is exchange rate increase, or you can say the domestic currency is depreciating, that depreciation will be encouraging exports, discouraging imports. Same for devaluation. And appreciation will do the opposite, encourage imports, discourage the exports, and then accordingly the BOP equilibrium can be reattained. A typical way, in which we have seen that part, but the core idea is that it is only the capital flows. You can even go and talk about the Marshall-Lerner condition here, which is quite the later part of elasticity approach. Marshall-Lerner condition tells that if the sum of price elasticity of demand of import and that of export is greater than 1, then overall it will be leading to improvement in BOP. Okay, balance will be when it is equal to 1. So basically when the this is price elasticity of demand. How is absorption approach different from here? In the absorption approach we talk about multiple things, but why the name? Absorption approach is telling that it is from the limitation of the elasticity approach. Absorption approach tells that the nation must be having lack of full employment for elasticity approach to function. Why so? This is in the sense that if there is depreciation, the exports will increase. Exports will increase when there is scope for export to increase or full employment is not yet there. So the word absorption comes from the fact that if full employment is reached, then the increase in exports will have to be absorbed somewhere in the domestic economy by lesser expenditure elsewhere. So by the standard Keynesian aggregate demand, if one component goes up, the other should come down if AD is the same. That is the idea over here in the absorption approach. The other things which are different is they allow for the foreign capital flows, unlike the first approach. Okay, so in the absorption approach, the capital flows are allowed, and that is what explains that how economy can kind of change its full employment level of output itself. Okay, and through the foreign capital inflow, the BOP can keep on improving. Basically, in the current context, when we do BOP, it is more influenced by absorption approach. Okay, but time to time, even elasticity approach have their impact. At any given level of foreign investment in a country, the elasticity approach is also quite useful. Basically, it was a general question, discuss the two approaches. So as much as you can write assumption, the features, the differences, and so on and so forth. I don't feel you will be able to draw many graphs, etc. The only way that you can bring graph here is through the J-curve approach. Okay, J-curve approach is also linked to the elasticity approach in a way, which says that initially when the currency is depreciating, the trade deficit decreases, but at a later point of time it increases. So within elasticity approach, there can be more than one ways of looking into that. Let's go further. Okay, 6b was on Stolper-Samuelson theorem. It was asking, discuss the possible effect of free trade on income inequalities in developing countries. Okay, so there are few highlights you need to see. You first need to know what is Stolper-Samuelson theorem. Then you have to look into effect of free trade on developing countries in terms of the income inequalities. Stolper-Samuelson theorem that we talk about is basically looking into the impact of the relative price. Okay, so for example, it says that an increase in relative price of a good, for example, due to higher tariffs, leads to higher income of factor in which good is intensive. As in, if the good is labor intensive, it will lead to higher wages. If the good is capital intensive, it will lead to higher income for the capitalist. Okay, so that is the Stolper-Samuelson theorem. When there is free trade, we expect that there will be labor intensive good moving from one country to the other, and same for capital intensive. That can impact the overall income levels of the factors. Okay. And then you have to bring in developing countries. You can say it this way: most of the developing countries have comparative advantage in labor intensive product. So they are exporting the labor intensive product, importing the capital intensive product. Suppose now that on capital intensive product tariff is increased and it becomes costlier. So what will happen then? The capitalist class will get more income. In a developing country which is importing capital intensive good, if tariffs are increased, it will redistribute income in favor of the capitalist class, and hence will be leading to more income inequalities. You can take India as an example here, although not being asked in a 15 marks question, you can do that and take some of the specific examples out there if you can. India would not be the perfect example because India is a big country where we are importing labor, capital intensive both. The example would be more perfect when we talk of smaller countries which are dependent mainly on the agricultural exports and industrial imports. Say some African countries, for example, okay, can be taken up as a better example of that particular part. Okay. Although not same, this conclusion seemingly is very close to the Jagdish Bhagwati's immeasurizing growth hypothesis, which also tells that free trade is actually increasing income inequality. But that is based on other aspects. So we are not going into that. The last part was explain how the elasticity of demand for foreign exchange is influenced by the elasticity of home demand for imports and by elasticity of home supply of import competing goods. Okay, so basically when they talk about home supply of import competing goods, here they are thinking somewhere in the context of exports, something which we are competing with the import, home supply of the import competing good and that of the import itself. Basically here you can apply the Marshall-Lerner condition again. Under the Marshall-Lerner condition, they talk about the elasticity of import and that of export. But in the context of home supply of import competing good, it is like we are avoiding that particular import. Okay, we are replacing that particular import, thereby saving our import dependence over there. Explain the Marshall-Lerner condition and the J-curve hypothesis, etc. in that context, and that should be answering the question. Moving further, these are some questions related to growth and development. Explain how structural transformation in the economy takes place with surplus labor as per Lewis' theory of economic development. One of the standard questions again, I am sure all of you have done Lewis' theory of development, where Lewis assumes that there is an economy and agricultural sector in the economy where we have subsistence wages. Okay, due to subsistence wages, whatever production is happening, there is a definite surplus coming out of it. And as the production keeps on increasing, this surplus also keeps on increasing. This surplus can be used in industrial sector to produce more. So if we have y1 equal to f of kl initially, or kl1, it can be y2 equal to f of kl2, something like that, where you can talk about the L1 and L2 over here. So this surplus which is coming in keeps on getting invested, and that is how the theory is explaining the growth over there. So that is the basic Lewis theory that we talk about. And the details I'm sure you have read about. This is one of the standard theory. Structural transformation in the sense that this is agricultural sector and this is the industrial sector. Gradually, the structural transformation of the economy takes place from agriculture towards the industrial sector. And fill in the other details over here, like how this profit is taking place and so on and so forth. Okay. Don't forget to mention the assumptions in the 20 marks question. In any question, but mostly in the 20 marks, it's very important. In the assumptions, you can write there are two sectors, agriculture, industry, or advanced or relatively backward sector. There is dualism in the economy. Dualism means that they coexist in the same economy still. The overall standard of living or income is very different. Wages are subsistence in agricultural sector, which means at given wage level, any labor amount can be supplied. Infinitely elastic supply of labor is the famous assumption that Lewis goes for. Then you can say the labor can be seamlessly be migrating to the urban sector or to the industrial sector, which is leading to higher and higher economic growth and so on. So assumptions itself should be done in detail, because after assumption, basically you have to draw a couple of graphs and explain them. There is nothing much material also that you can write upon. The question is straightforward. They are not even telling you to critically analyze or something. Had it been a critical examination based question, then you could have brought in what Fey-Ranis model tells and so on. So that is being ruled out over here. So B part, what are advantages and disadvantages of PPP, public-private partnership model for economic development? What are key prerequisites for the success of PPP model? Explain giving example. This question can easily be regarded something like a paper 2. Because when you talk of advantage, disadvantages, you can bring India very clearly in the context. So, what kind of advantages, disadvantages can be talked about here? Advantage is that there is easier financing of infrastructure projects, because the private sector is capable of putting in money. There is share of risk or share of different types of risks. Between public and private sector. The risks are unique actually here. Like regulatory risk is often handled by public sector, the government, getting the clearance on certain things, some regulatory approvals, etc. Private sector related risk are mostly the market risk. Okay, they take up that kind of a risk. So these are some of the advantages that can be talked about. Disadvantages can be something like there may be cases of lack of clarity on revenue sharing. Although we do have the models of PPP which tells how the revenue will be shared, but we have seen real examples where the revenue sharing problems have come in, like in the airport metro, which was done on PPP with Reliance, etc. There was a lot of conflict in that particular case as well. Then you can say it is not much suitable for brownfield infrastructure projects. And within brownfield also you can give some examples specifically. Infrastructure can be greenfield or brownfield. Greenfield means starting from scratch, a new type of infrastructure where triple P is always better, like building a road. Okay, there is nothing that need to be demolished, something which is just to be built. Brownfield infrastructure is where there is something existing need to be removed and then brought in. Triple P is complicated when we talk of infrastructure like the metro trains, as we have seen, because in order to build the metro linkage, there are many other infrastructure or many other things which need to be demolished or kind of made unavailable. That often leads to complications over the triple P model, or maybe the infrastructure related to repairing some gas pipeline or water pipelines, etc. There it may not be so suitable. Okay, feel free to give more examples over there. What are key prerequisites for success of triple P model? It's related to the first part in the sense that wherever you will see the advantages coming in, you can call it the prerequisite, and you can use the disadvantages also in a reverse manner. So for example, you can say for prerequisite, we should focus more on those projects which are greenfield. We should focus where the risks are very clearly segregated between public and private sector. Okay, revenue sharing mechanism should be very, very crystal clear over the project and so on and so forth. Explain giving examples. I gave you some examples. Feel free to give more. Like in highway construction, etc., triple P has been very successful. Simpler infrastructure, greenfield infrastructure, and also don't forget, triple P will be more successful when the revenue generation is quick. So in highway, etc., the tolls ensure that the revenue generation is also quick from there. That is how it is sustainable to public and private sector to come together. The moment we have riskier project where the revenue generation will be time taking or slightly uncertain, okay, that is where problems may come in. For example, compare the Delhi metro, which is interior, versus the airport metro. Okay, airport metro is not that predictable in terms of getting consumer traffic as the interior metro. That is why in the standard Delhi metro, that kind of fare related issue didn't come up while it came up in airport metro. You can give similar examples elsewhere. Wherever the revenue generation is complicated, time taking, the triple P may not be very successful. So it's a descriptive question, you can keep on writing. We have somewhat limited time, so we'll move to the remaining part. Discuss the issues, pros and cons in the debate over import substitution and export promotion strategy for developing countries. Which strategy would you favor and why? Explain. Again, this is more of a descriptive question. Import substitution means that discouraging imports of the goods that can be domestically produced. You should know the meaning, etc. also. Export promotion is clearly about promoting the exports, as you can see that. The debate is that which should be followed more, although there is no hard and fast rule that both cannot go together. Okay, we have seen many developing countries like South Korea, etc., during 1960s and 70s following both simultaneously. On one hand, they discouraged imports of what they can domestically produce, and on the other, encourage the exports also. Okay, it sounds contradictory but may not always be. Actually, this debate was less in earlier decades, 60s, 70s, 80s and so on. But now, with the formation of WTO, etc., that has become more difficult. Okay, in the WTO context, export promotion is favorable. Import substitution is not favorable, because import substitution will be against free trade. And there is a growing agreement over the argument that each and every country should be promoting free trade as much as possible. There should be more opening up of export, import, etc. In that context, import substitution is not very much fitting in. India also followed import substitution strategy till at least around 1980s or so. Gradually after 91 we have to give up. In any case, in 1995 WTO get established, so we had to give up on that. So we began with very import substitution policy after independence, okay, but we didn't promote exports. That's where India and other developing countries are different. So you can write a lot on this. Within developing countries also there are multiple combinations. You can give example of South Korea, which was once developing country, followed both of them together, while India just followed import substitution, not export promotion. And then after discussing all this, when they say that which one will you favor, I would say export promotion for many reasons. Okay, reason number one, in the current political or global concept, import substitution in any case is not possible. Okay, India will have to kind of leave WTO or something like that if they insist on import substitution. Export promotion is globally more acceptable. Okay, so that's reason number one. Export promotion also improves efficiency in the in certain sectors, because whenever we export something to the other countries, it's not that we have to produce it, we have to produce it in a highly competitive manner, sell it at a relatively lower price in order to remain competitive. Exports are clearly directly contributing to GDP, job creation, although jobs can be created even in import substitution. Okay, so that argument will go in favor of both. So accordingly you can argue about it. These are quite descriptive questions and there are more than one ways of writing the answer. So I will not force you a lot that you should follow whatever I am telling. Okay, and that brings us to the last question. Let me just confirm if I missed something. No. So this is the last one. Describe the major components used in HDI, Human Development Index of UNDP. Write down methodological limitations. Suggest appropriate method to eliminate these limitations. Okay. Again, a very straightforward question. Major components, the first thing. The major components used in Human Development Index. I'm sure all of you know. In HDI, there are 3 dimensions. The dimensions are health, education, standard of living. This is a 20 marks question. 10 is for the major components. So you'll have to write a lot more. For example, you have to write the specific variables used for it. Like for health, there is life expectancy. For education, there are 2 indicators, which are the mean years of schooling or average years of schooling. This is for adults, and the expected years of schooling used for children. Expected as in given the current enrollment rate, for how long do we expect the children of a household to be in school. Standard of living through per capita GNI at PPP, purchasing power parity, the per capita gross national income or gross national product. In fact, the second part is now telling write down methodological limitation. For that you have to write method also. Okay, so what is the method basically? They have 3 types of index coming from there. So life expectancy index, similarly education index, and the standard of living index. How are these indices calculated? It is calculated on the basis of, so any dimension index is calculated on the basis of the general formula actual value minus minimum value divided by max minus min. max value minus the minimum value. You must have done. Those who want to read more on this can also easily find those documents from UNDP websites. It's openly available. Every time the Human Development Report comes, they also give a summary of it. Okay, and there is also a note by the name of technical notes in the Human Development Report. Technical notes should be there with you, because in technical notes of Human Development Report, they discuss the method of each index. One question on the methodology of such index is coming almost every year in the exam. Sometimes on gender development index, sometimes on human development index. So be ready for that. You should have that technical notes. So this is the method, and then what they do, they take the HDI as geometric mean of the three indices. The geometric mean of the three indices. One more thing I forgot to tell, when they calculate the index for standard of living, it is not actual minus min, but it is log of actual minus log of min, and so on. Because the per capita income is highly inflated component, it cannot be directly compared with the other variables. So there is a compression needed to be done. To compress that, the log function is used. That is the idea behind that. And then they take the geometric mean. Okay. They are asking also that what are limitations of it. Although overall HDI has improved over time, but still you can claim some of the limitations. Like one improvement was shifting from arithmetic mean to geometric mean. Till 2009, it used to be arithmetic mean of these indices. It changed to geometric mean. It was a methodological improvement in the sense that arithmetic mean is more influenced by the extreme variables, which geometric mean is not. Yet you can give a number of problems, like it is not very fair to compare health with education with standard of living. That is a common problem in almost all indices of HDI. They are all important, but combining them in a mathematical way is not very fair. Okay. Again, we are combining very different things in education, average and expected. Okay. Expected is a probabilistic measure, average is the actual. Life expectancy is also expected variable. Per capita gross national income, etc. is the actual one. So that is another issue that you can talk about. Then you can say that sometimes these max or min values can be two extremes. Okay. And not denoting even the achievement of the better of human development countries. So that way a particular country may end up in relatively lesser degree of human development due to that. When they say suggest measures to eliminate it, you can just reverse the argument. You can say that ideally we should be having more subjective way of looking into it rather than just the mathematical approach of that. Okay, you can talk about even more variables being brought in within that, perhaps not just life expectancy, but some other variables can be brought in over here, and so on and so forth. Whatever you wrote in the limitation, you can sort of reverse it over there. Although we take log of gross national income, despite taking logs, however, there may not be enough compression which is coming in, and some of these things can be improved upon. Okay. Moving on to the B part of it. Discuss the inverted U-shaped hypothesis by Kuznets in describing relationship between inequality and economic growth. How is this hypothesis useful for developing countries? Straightforward question. This is a very common question that comes in inequality. It says that if you have some inequality measure, let's say Gini coefficient. Gini coefficient is a common inequality measure, and on the other side you write say economic growth, or you can just say per capita GDP. Generally, per capita GDP increases with economic growth. Kuznets had said that there will be an inverted U hypothesis. As in, initially as the per capita GDP goes up, inequality goes up, reaches some peak and then declines. What was the logic given by Kuznets? Because the 10 marks is for first part, you have to explain why it is the case. Kuznets claims a number of reasons for that. Reasons like initially the country's main focus is on growth and not distribution. Like initially when the industrial revolution started in Europe, they were not very serious about distributing the fruits of the growth, but growing more. Okay. Later on, the distributional aspects come in. Okay. Then another reason can be skill development over time. As the country goes through a longer time period of growth, the average skill development improves. Skill development leads to higher wages of the common workers, and that is how the income inequality tends to reduce. You can also talk about the welfare role of government. Gradually, government acquires more and more welfare role, like by giving more subsidies or by giving more jobs directly. Like in India, we have MG Narega kind of a scheme where government is providing jobs. So these things also tend to reduce the inequality. Feel free to give more arguments if that comes in. The question is also asking, how is this hypothesis useful for developing countries? Although realistically speaking, we do not see this hypothesis working for many developing countries, including India. You can bring India here and say that in India actually, since 1980s, when the per capita GDP has gone up, inequality has only been increasing. There is hardly any clear-cut indication of decrease in income inequality. So for developing countries, it doesn't seem to be very correct. Okay, but you can say it can be useful still because the lessons are very sensible. It can give the arguments that developing countries should also take these steps in order to improve. I think that it should have been a little more marks for the second part also, because the hypothesis as such is quite basic. So fine, you can't do much about it. You can give more of reasons in detail in first part, and the usefulness you can write these things more briefly. That is one thing that you can do. And coming to the final question now of the paper 1. Distinguish between warranted rate of growth and natural rate of growth. Explain how knife edge instability problem occurs in Harrod's model of economic growth. Again, a very standard question on growth and development. Harrod's model uses 3 types of growth. 2 of them are here, which are warranted and natural rate of growth. In the warranted rate of growth, something like GW, you can say, Harrod talks about the ratio of 2 things which are related to the fact that when we are having certain amount of savings, let's say S, then if we divide it by some amount of capital output ratio, let's say theta, and you can also write a subscript R over here, where it is required capital to output ratio. This theta R is required capital to output ratio to achieve the warranted rate of growth. S is the savings rate. What is natural rate of growth? GN. GN is the potential growth rate of an economy based on population growth, productivity growth, etc. So suppose that population growth is n, productivity growth is given by lambda, just a sign you can say, then you can say that the natural rate of growth will be n plus lambda. As in, generally higher population also encourages higher growth and productivity also. So these are the two things. And what Harrod's models say, that in equilibrium, the warranted rate of growth should be equal to the natural rate of growth. And that is what leads to knife edge instability problem. Okay, why do we call it this way? Knife edge instability problem. Let's look into that. So as you can see, for this to occur, these two should be equal. For warranted rate of growth to be equal to the natural rate of growth, we should have S upon theta r equal to n plus lambda in our case. Now the problem here is that these are all kind of constant. Okay, theta is given exogenously. And even the rest are more or less constant. Savings rate, population growth rate, etc. That is why we say that the model is overdetermined. The Harrod's model of economic growth is overdetermined. It's a slight mathematical language. Overdetermined model means that kind of everything is assumed to be the same. There is no unknown variable which is to be determined. Perhaps the most common unknown variable should have been theta, which is capital 2 output ratio. It is not necessary that it will remain same. And the other interpretation of this given exogenously is that the model assumes L-shaped isochronds. L-shaped isochronds mean labor and capital used in same proportion for all production. Something that is not realistic. Actually, in most of the production, we don't have L-shaped isochron, we have a fine downward sloping convex shape. So this L-shaped isochron fundamentally creates this problem. The neoclassical economists like Solow criticized Harrod's model mainly for this aspect, that had theta been taken as being determined endogenously, then the problem would be solved. But why the name knife edge instability? If by coincidence in an economy the LHS S upon theta r is equal to n plus lambda, then there will be equilibrium, otherwise not. Otherwise, economy will be on permanent path of disequilibrium. That is why the term knife edge as in by coincidence there may be an equilibrium, and even if there is a minor you can say imbalance on the two sides of the equation, the economy will go in disequilibrium, which is not how typically the economic models are looked into. And that is how Solow, the neoclassical economist, changed this model, making the theta to be relatively endogenous, and obviously this question is not expecting that to be written, but questions on Solow model is also very common. One question on growth model is actually very common, and maybe two also in this case. So that completes our question paper discussion. It has been quite time taking, but I thought I should be giving enough time in terms of handling some of the complicated questions. At least some of them were very simple, I agree. So overall, let's now have a brief overview of the kind of question paper which it was. I will call it overall a simpler question compared to many years, because except a few technical ones, they were very standard, like the last question, or many others were quite simpler. So wherever you had option of leaving a question, it was not so difficult. Like this question could have been attempted by anyone, I would say. Lewis model, Harrod's model, everyone would have done, I'm sure. The main tricky part was in the compulsory question when it was new, something like ad valorem tax related question. That could have been slightly more problematic, and also that many students don't give enough emphasis on the classical theory, keep on focusing more on the other. There are two or three unique absence from the question paper. Why am I telling you this? Because since they have not been asked in this year, the probability that it may be asked next year is slightly more. Although nothing can be predicted, the exam is quite unpredictable. One is the question on oligopoly has not been asked. I think this is first time in maybe 10 or even 20 years that there is no straightforward question coming from Cournot model, Bertrand model, Stackelberg model, etc. Not even something like game theory, Nash equilibrium. Although thankfully there were questions on market. Both the questions were from monopolistic competition. One on perceived and planned demand curve, one was on the short run, long run equilibrium in the monopolistic competition, up to the discretion of the question setter. But normally we have seen oligopoly related questions coming in the exam, and generally a numerical on that also. If not numerical, something which is numerical based approach needed over there. So prepare very well, those who are appearing next year or coming years, on these oligopoly models, including the numericals, on which I devote enough time in the class. We discuss these models in a mathematical manner plus graphical manner, and also I give some numericals for practice, which has been very common over there. Secondly, no question from theory of distribution. Okay, although this year is not unique, for last 2 years I am finding no question on Calder, Kalecki theory, Ricardian theory, etc. Calder theory has been a favorite area, but I would say don't take chance. Do the 3-4 theories of distribution very well for the coming year. Okay, mainly the Calder, but also Kalecki, Ricardian theory. If you can have a little idea of Marxian theory, that will be even better, because questions have not been asked, but still the possibility remains. Okay, these two things. And the third thing, in macroeconomics, overemphasis on classical in this exam. Sometimes they are linking classical with Keynesian, but there is only one question which is more directly talking about Keynesian, the underemployment equilibrium. And even in that case, when you are explaining why there is underemployment, you have to know why in classical that was not there. So macroeconomics is more important, it seems here. Even in international part, there are more questions on macro. Okay, that is the fourth observation. Coming to that, first of all, the third one is that on macro, most questions are either on classicals or near about. Okay, they didn't ask a question on new classical, monetarist, new Keynesian, etc. You can expect something of that sort next year. Okay, new classical, new Keynesian. New classical particularly has been very common over there, or monetarist approach, the Phillips curve, Friedman's approach. There were no question being asked over here. And the fourth one that I was talking about is that in international economy there were enough questions, but almost all of them from macro part of international economy. So balance of payment, the managed floating exchange rate, etc. They are all the macro part of international economics. On micro part, okay, offer curve was there, fine, that I now remember. Offer curve is microeconomic part of it, but they have asked many questions on micro part of international, like on Heckscher rolling model, the questions have come. Even on the basic models like Ricardian comparative advantage theory. And one of the favorite area which they didn't ask this year was on new trade theories. In new trade theories, the questions like intra-industry trade, product cycle, model of trade, etc. So be prepared for it. So I think these are 3-4 observations that I can make. And if you noted, I had made observation more about what didn't come than what came, because whoever has written this has written. Okay, we can't change that much. Those who are the future students who are going to write down should be more carefully observing this. Okay, and I know some of the discussions were brief because the time limitation is there. We took, I think, more than 3 hours even if we do briefly, and that is where your self-study cannot be substituted. Your rigorous self-study, and by chance if you are taking some kind of advice, the kind of coaching that you take will also be helpful, because in the classes I discuss these things in more detail. So feel free to talk about any doubt if by chance if you are facing over here. I'm just giving my email ID because some of you may not be from the institute, etc. By chance if you have any query or anything that you can add to what we have done, feel free to mail me, or anything, any clarity that you need in general related to economics preparation. It is SHYAMSUNDER Shamsundar 14 without any space @gmail.com. I would welcome any comments, any additions that I have taken up here, or anything that you thought that can be improved upon. Okay, so all the best for your exam. Thank you very much from my side. That's it for today. Thank you so much.